banks have given me over $35 million of loans to go out and acquire over $50 million worth of multifamily properties, just like the one right behind me. In fact, I'm getting a $7 million loan on this property right now. So how in the world does all of this work? It all starts with the deal. Now, the most important thing is that 90% of the lender's decision-making process, whether they give you the money or not, isn't based on your personal credit or your personal income. It's based on the deal itself. Because multifamily is valued and treated like a business, lenders make their decision 90% based on the income in place at the property, because the property has tenants that pay rent every single month and there's contracts to back that up. So they're not looking at your income, they're looking at the property's income. Now, here's what I mean when I'm saying the deal. This is the current condition, meaning how old is it, what physical improvements do you have to do to the property to maximize the value, the current rent roll and the income that the property is bringing in, the current NOI, which stands for net operating income, which is all the profits after the expenses have been paid, and then lastly, the future value or the upside on the property. Now, with all this information, you're going to be able to determine what type of debt you're going to want to place on this property, because in multifamily, there's different types of lenders. So when it comes to financing a commercial real estate building or multifamily real estate, there's generally 3 different buckets of money that you can go place on it. Starting from the top, these 3 different buckets are agency debt, which we'll go through in depth, bank debt, and then bridge debt. Now, agency debt is a government-sponsored agencies. This is Fannie Mae and Freddie Mac. These are the largest lenders in the entire country. Now, agency debt, just like any other government out there, it's very strict and it has very cookie-cutter check boxes. So this bucket of money is going to generally give you the best terms, meaning the amount of loan that you can get and the interest rate that you're going to be borrowing at. However, they do have very strict qualifications, which we're going to go through. Because you're going through such a strict process and they look at everything, they generally give you the best terms out of these 3 options. The second bucket of money that you can go to is what's referred to as bank debt. And banks operate in a very similar manner to how agencies operate. The biggest difference is that banks make their own decisions. They have their own investment committee and they meet and they're able to kind of bend the line a little bit and get a little bit more lenient than a government agency will. So the biggest thing here is it's a relationship-driven lender. They do have a similar vetting process to an agency as far as underwriting the deals and underwriting the borrowers. Now, banks oftentimes have very competitive terms because they know that they're going to be competing against an agency. So again, if you have a relationship with these banks or somebody else around you does, you might be able to get just a little bit better terms than an agency, and it's a little bit easier to qualify for the loan. It doesn't mean you can just go to a bank like 2008 and get unlimited money. They still do vet you out. And if you stay till the end, you will know exactly how you can go through it and get millions of dollars from these banks. Now, the last bucket of money is called bridge debt, and this is very similar to hard money lenders or private lenders in the single-family home world. This is by far the easiest money to get as far as qualifications and all the documents that they're going to put you through, but everything has its pros and cons. It's very easy to get into, but it is very expensive as far as the interest rate and fees that you're going to be paying for. And then just in general, this carries the highest amount of risk that you can take with financing an entire property, because they're shorter term loans, they're floating rates, meaning if rates go up, so does your rate, and it's not fixed. So easy to get, but very expensive, just like hard money lenders. Now, the reason I say that everything starts with the deal is because, for example, let's say that you had a property that's been owned for 20 plus years and the rents are so far below market, you might not be able to qualify for an agency loan or a bank loan, but there is a tremendous amount of upside or value to be created at the property. You would probably take that deal, place bridge debt on it, and go in, get all of the improvements money that you need so you can fix the property, and then refi into one of these 2 options, either being agency or bank debt. Now, if you flip that example around and the property has decent income in place and you can move it just a little bit, but you don't want to take a high level of risk on that deal, then you're going to take that deal and you're going to shop it between an agency loan and a bank loan and see which one you can get the best terms from. So everything, again, starts with the deal. Now going into the qualifications behind it, the reason that you clicked on the video, you're probably wondering how in the world does somebody get a loan on the property if you don't have enough money in the bank or if you don't make millions of dollars every single year. Now going down to qualifications, just like I mentioned at the very beginning of the video, 90% of the decision-making process of these lenders is not based on you or your personal credit or your personal income. It's based on the asset and the income in place. Going through the qualifications, I break it down into two: the deal level, because again, that's the most important, and then the borrower level, or the sponsor, the person that is actually running the deal and in charge of it. Now, if you're going to be getting an agency or a bank loan, this is generally how they're going to qualify it. The number one thing you need to know is what the DSCR stands for. This is debt service coverage ratio. All it means is how much income is in place versus how much debt you actually owe to the property. And the metric that you want to look for is that the property has greater than a 1.25 ratio. And to simplify it, just so you can actually see it, let's say that the property has $200,000 of income, it has $75,000 of expenses, which means the net operating income for this property is $125,000. That's the profit before you pay the debt service. And you want to go get a loan, and the interest on that loan is $100,000 a year. The DSCR in this case, you would take $125,000, divide it by $100,000 of debt service to get 1.25. This is the minimum that you want to look for if you're trying to qualify for a loan. And then lastly, for the deal level, they're looking for at least 90% or more from an occupancy standpoint. And that's really it. If you can find a property for $1 million and you want to go get a $750,000 loan, as long as that property has enough income measured by the DSCR, then you'll be in a good spot. Now moving on to the sponsor level. This is what everybody gets trumped over. And I'm telling you, after getting $35 million of debt at the age of 27, these lenders look at me at first and they're like, what do you think you're doing? And then they see everything that's actually happening. They're like, okay, you understand the game. And when the lender is done looking at the deal and they're finally ready to start looking at the borrower or the partnership with everybody in it, these metrics are measured on a collective basis, meaning if you and me did a deal together, they would be looking at our experience, not just yours, our, that's the key word, us together, our experience, our net worth, and our liquidity. Here are the three metrics that they look for to make sure they'll qualify you for the loan. The experience is the hardest part to find. You have to find somebody that has 3 deals acquired within the last couple of years in a similar size to the one that you're going out and buying. Now again, this is where agencies and bank kind of get a little bit separate, because if you have a great relationship with a bank and you only have 1 or 2 deals, they might be able to qualify you, versus agency, it has to be 3. So if you're brand new and you've never done a deal before, that's why it's so important to be a part of a community like the Deal Room, where you can leverage other people's experience to get into deals. The second one is net worth and liquidity. They want a 1-to-1 ratio when it comes to the net worth. So for example, the deal I'm doing right behind me, it's a $10 million transaction. We're getting a $7 million loan. Between me and my partner, we have a $7 million net worth. And then for the liquidity, after you're done closing the deal, they generally look for 10% of the loan amount or greater. In this example, again over here, it's $700,000 of cash after you close the deal. Now, you're probably not going to start with a $10 million loan. This applies at any level. So to recap this again, for the qualifications, you can do a $2 million loan, a $20 million loan, a $200 million loan. It all is the exact same. They're going to make the decision 90% based on the deal and the current income in place. That's why it's important to understand DSCR. And then for the sponsors and having the right partners, this is why I say you can't do deals alone in this business. You have to have partners. They're looking for collectively, between everybody in the partnership, enough experience and net worth and liquidity to sign on the loan. And that's really it. We've done this over and over and over and over again. And I'm telling you, after you get into the first deal, it just gets so much easier. And so if that's you, if you're an investor and you're looking to get started in multifamily and you're realizing, man, I can actually do this. I can go out and learn what a great deal is and know exactly how to underwrite, so I know what my DSCR is, and you're just looking for some help with the partnership and making sure you can have enough experience, then go ahead and click the links in the description. Check out our community, the Deal Room. We have hundreds of investors across the entire country that are actively doing deals, people with experience, people without experience, and we're helping pairing them together. That way everybody wins, they make money, you get started in the business, and everybody can grow. Then check it out. We have a completely free 14-day trial for you to get in, start connecting with other investors, and even showing up to our live calls to see exactly how this business works. Hopefully you found a ton of value in today's video. If you did, as always, make sure you subscribe, hit the like button, and comment what you want to see on the next video.